More than 70% of e-commerce sellers in Canada make these fatal mistakes that are costing them thousands of dollars in tax. But most importantly, it's leaving them exposed to CRA audits. Let's talk about what those are and how you can avoid them so you can run your online store stress-free.
Hi, my name is Sal, this is Jaz, and we're here from SAL Accounting. So Jaz, let's just get right into it. The first mistake business owners make is mixing personal and business finances. Talk us through that a little bit.
It's a common mistake that happens with a lot of like small businesses or entrepreneurs that are getting into the e-commerce business side of things. Where you're set up with Amazon, you have a business account set up with them, but now where do the funds come, right? So a lot of times the funds are set up in a way where it's coming under your personal account, or there's no separation between that. So the confusing part ends up being is that at the end of the year, they're saying, okay, well, all my funds and expenses are going out of my personal account. Well, that's mistake number one, and it's a big mistake because now how do you differentiate between what is your personal expense and your personal income versus what is coming from the business side of things, right? In scenarios like this, we've seen CRA fully exclude any of the expenses that the person's trying to claim because now there's no separation in the bank statement or anything like that. So we run into this situation where even for the owner at the end of the year, it's very hard to track. Okay, well, what did I really spend the money on, and is this actually a business expense or not? Right? So that's actually like one of the biggest form of mistakes, and our recommendation is always, if you have a registered business, whether you're even a corporation or a sole proprietorship. So that's the other kind of component to it, because sole proprietorship is also a business, but it doesn't necessarily have a distinct entity in itself, right? So you are able to kind of have the funds be in your account and things like that. Whereas in this situation, like we always recommend, if you're starting a business, whether it be sole proprietorship, whether it be a corporation, and regardless of the entity that is set up for it, having a separate business account so you're able to track the income coming in as well as the expenses that are going out for the business is very critical.
And I want to add to that if you cannot get a business credit card, for example, right? Like, because a lot of times people are, for example, buying from the US, they want to have a US dollar card, right? They don't have a business US dollar card, or they might not even have a Canadian business card. It is completely fine, and I will obviously add to this. It is fine to use your personal card as long as that's isolated for the business and there's no personal transactions going through. So that if the CRA looks at it, you can't say that, oh, I also went to Walmart and did some shopping on it, right? Because then there's no separation and there's no way you can prove that this expense was for the business.
It's very common for new businesses. They don't have any credit history, so sometimes banks are not keen on extending a credit card or anything like that right on top of right when they incorporate. So yes, you are able to use your personal credit card, and like you mentioned, like you cannot mix the two as long as it's separate. And you know that this credit card is specifically for business-related expenses, you are able to showcase that and utilize that for your business.
Yeah, like for a small example, right? If taking the example of this furniture, right? We go to IKEA, we buy this furniture, and if that credit card just has business expense, we can say to CRA that, hey, this furniture, as you can see, there's no personal transactions from here. Even this furniture that we bought is for the business. But if CRA sees there's personal and business transactions intermingled, how are you going to prove that this furniture I bought, as an example, is for the business, right?
Yeah, and it gets,
because this is a gray line.
Exactly, and it gets difficult, and then the easiest thing for CRA is to be like, okay, no, you cannot claim the expenses, and then for some expenses it can be a large amount as well that can get vetoed here, right? So it's crucial right from the get-go, have it separated, make your life easier. You know where the money's kind of coming in and going out, so you're not mixing the personal and thing. And the other thing I want to add to this, and oftentimes the reason why this gets mixed up is people want to be able to use the money that they're earning in their businesses, right, for personal expenses, and that's really where the tax strategy kind of comes into play here. Is that you need to be able to see how much money you're able to take out from that business and take it out of that business account and put it in your personal, and let that be either a dividend or a salary that you're taking out from your business and utilizing that for your personal expenses. You can't just be taking out money, using it for expenses, and then have that be a crossover.
The second mistake that business owners make, and I think it's very related to the first one, is actually missing some of the expenses that they could actually claim, right? And it's related to the first one because if you don't have segregation, you're not able to see which expense can be claimed on the business side and which expense is completely personal.
Yeah, and then I think this happens also, the convenience factor, I like to kind of call it, where if you're out and about and you are purchasing something and you don't have a business credit card or you don't have the business card available, you're likely to buy things on your personal side, which then you might not recall down the line. So it could be as easy as subscriptions, right? A lot of times that's the easiest thing that's kind of going out of your credit card, but it might be for the business, and there's no track of it, right? Because they're happening on a separate card and a separate place for your personal side. And now not only are you missing expenses for the business, but also the ITC that kind of comes along with it. So again, it's very common for these kind of expenses to happen, and for business owners to be able to be putting them under personal. So at the end of the year, we always ask the client, hey, were there any expenses that you incurred on the personal side that are actually related to business, right? And we often find that sometimes there are like those eureka moments where like a client's like, oh yeah, actually there was this one expense that I paid out of my personal credit card, and it was, like I went for this, conference or whatnot, and it was never claimed on the business side. But now, like again, those are things sometimes because we're, mixing up the two, that we often forget about those expenses.
Thank you for that. A common one that folks miss is work from home expenses, right? You're using your home, a part of your home, as your business, as your work from home office, right? There's electricity you're paying, there's hydro you're paying, there's gas, there's even condo fees, right? And your mortgage interest, that's a huge one, right? That you can claim in your business side, right? Is there anything else that people should be claiming?
When you start off as an entrepreneur, there's a lot of upfront stuff that you do personally for your business. So yes, like, sometimes you're not out there and you don't have a retail storefront, and you're kind of operating just within, a room or an office room that you have set up in your house. We do have the capacity to claim those portion of expenses. Now, I'm not saying you're going to claim the full amount of your mortgage. It is prorated based on the space you're using at your home that is strictly for business related activities versus the overall space for your house. That proration then applies to all the expenses that you're incurring on the personal side, and you are able to claim those under the corporation, and then have that be a period expense for the year. The same goes for your automobile. So if you're traveling from your home to meet a client, or to
drop something off,
or whatever it may be, whereas you're using the vehicle to essentially do business related activities, you are again able to claim either a mileage expense, right, from the car, or if there's a certain amount of your vehicle that is strictly being used for business, again, that same proration applies to your vehicle, where now you're looking at the kilometers that you travel specific for business related versus the overall usage of your car for the year. And then your insurance, your gas, all gets prorated alongside
oil
of that.
Changes.
Exactly. So that all gets prorated alongside of that. One of the things that we usually recommend to ensure that these kind of expenses are not missed is, when you're filing your whether it be your quarterly or your annual HST for the business, we recommend doing sort of like what we call a expense claim. And it's very common in large firms. I mean, even when you're an employee, you get to do an expense claim to your employer for the expenses you incurred personally. And similarly, as a shareholder or director, you're able to make those expense claims to your business for expenses that you've incurred personally for the business. And having this exercise that you do on a quarterly or an annual basis allows you to kind of keep on top of these, and also not, because then you're not relying at the end of the year to figure out what kind of expenses you may have incurred. Whereas if you keep on top of it on a quarterly basis, you have a template, okay, the house expense, the vehicle expense, any other things, they're fresh in your mind, and you're able to kind of put that through the business and reimburse yourself for these expenses.
Yeah, no, for sure. And I'm going to harp again about separating the personal and business expenses, because, well, technically you can have a spreadsheet of all the expenses you've paid from your personal credit card, but you don't have to, right? You just have a separate credit card for the business, and at the end of the year, there's only two things that you need to worry about. How much did you use your car for business, and how much did you use your home for the business, right?
Yeah.
And then it makes your life so much simpler, right? You could just do once at the end of the year, you could do your sort of the template we're talking about, which is literally just take all your bills and take all your oil changes and your fuel and everything and prorate them according to, for the home, it's the square footage, for the car, it's the kilometers, right?
Another thing I want to add on tidbit, and this is kind of popping up in my head because of a client, is, there's often times where there's purchases that need to be done on the business side, but then, because we're in the early stages of the business, there's actually no cash or credit lines available. So then you take a personal line of credit to fund that purchase. So oftentimes clients will provide the bill, like, hey, this is the bill that I have, and you're able to claim it on the business side. However, it's a very common mistake in this, is that they forget the interest portion of that line of credit that is being incurred on the personal side to make that purchase happen. Technically, that interest in itself can be also considered as a business expense, and you can claim it.
Third one is not registering for HST or GST when you hit the threshold, right? Now, obviously, we talk about that in detail in this video, right? But Jaz, because you're already here, you might as well tell us a little bit about that.
One of the things is that HST is something that we all have to know when to register for. And along with HST, there's, again, the PST side of things, QST, and the GST as well. So they have different time slots where you have to register. But just looking at the federal side of things, if your sales have hit the $30,000 threshold in a rolling calendar 12-month period, you do have to register for HST. Oftentimes, it's more reactively that entrepreneurs are looking at it and saying, okay, well, I've hit 45K and now I got to register. It's often not that, it's either too late, and in that sense, then they're liable to kind of remit that HST. But we like to say is try to be proactive. You have 30 days within that time that you've hit the 30K to register for your HST. And then not only that, CRA allows you to voluntarily register for HST right from the day that you incorporate. So you don't actually have to wait. You can get your HST number the moment you incorporate or have your business set up, and you're able to claim all the ITCs from day one.
You said a huge thing. I want to emphasize on that if you're late and you do not register for in time, you are liable for that HST that you didn't collect. So for example, you made sales of 100K, you should have charged 113K, but you only charged 100K because you didn't register for HST. CRA is going to ask you for that 13K still. So you're only going to get 87K in your pocket, right? That's a huge hit to your pocket. So that's something that we really, really want to be mindful of.
In these scenarios, the onus is on the business owners and the directors to make sure that they're following the rules and regulations that are set here in Canada. So if you fail to register on time, or you fail to not collect it once you've passed your threshold, you can't just put up your hands and be like, okay, well, I'm sorry, I didn't know. It will fall back on the corporation. The liability will go back to them because they were supposed to collect the HST once they've passed the 30,000. So that is a very critical point and crucial to know. But again, why wait? You could file a nil return if you don't have anything that's collected. So
register day one and file a nil return.
yeah, file a nil return if you have to. Yeah. And then if you feel like, you don't need a HST number, you can always close it. I understand, there will be some filings that you need to do, but nil returns is
pretty simple.
Pretty simple and straightforward to file. There's no complexity behind it, so why not?
The fourth biggest mistake that e-commerce store owners make is to record their payouts from the marketplace as their gross sales. So let's say if you made sales of 100K on Amazon and you got 90K in the bank after marketplace fees, you record 90K as your sales. That is the wrong approach. And Jaz, I want to again turn to you. Talk us a little bit about that.
One of the greatest things with these platforms is that they now break down your HST collectible or GST, depending on where you sell your product. So all that is done, and there's a beautiful report that it gives you at the end of the year. But often not, when we're doing the year ends, a lot of clients just base it on, okay, well, technically my sales is this because that's what I got in my bank account. But ideally, that's not the case. Because when it comes to CRA reporting, you do have to showcase the total sales that you made on the platform and then the HST that is there on top of that. We have to be able to provide a source documentation because technically your bank does not serve as a source documentation. So when you get that Amazon report, you'll be able to see, hey, this is my 100,000 is my sale, right? And on top of that, this is your HST, let's say 13%. So you would have that there as well. Then they'll have their fees, and then their fees will also have an HST if they're charging HST on those services. And then you'll have the net amounts, right? Those net amounts are essentially what get transmitted into your bank account. Now, we cannot utilize that as your overall gross sales component because that's not an accurate picture of your business.
Yeah.
And that is not accurately reporting your HST collectible and your ITC as well. So you need to be able to showcase those on two separate line items as the gross sales and also the merchant fees that you have. That is a separate thing that you would have to showcase.
And that's regardless of the fact whether you are HST registered or not. Even if you have nothing to do with HST, let's say you're selling to the US, you should still be breaking that out. The sales component, the marketplace fees, and then your net, right?
Yeah. And another example I would give to this is that Stripe is one of those things where a lot of people are processing fees as well. So, whereas you might be using a sales ERP system where you have your sales report there, that number is not going to tie into what kind of actually gets remitted into your bank account. There is going to be that difference. And that difference is actually the Stripe processing fee that might be happening on the back end. So, we can't just show that net of, because now if I show that as net of right away, my HST is going to be lower, my sales are lower, but the processing fee by Stripe might not even have HST on it, right? So right away, we're not presenting it accurately. So we do have to look at our ERP systems that we have set up and go based on the reporting that we have there, and then separately include the Stripe processing fee for the collection that we're doing for these payments as a separate line item.
So the final one, and it's a big one, is recording inventory as a purchase. So for example, you bought inventory on 30th of December, right? 31st of December, your year ends. Now you're just going to show purchases of, let's say it was $50,000, right? Jaz, is that correct? That if I've bought something that I've not used at all in the year and I have inventory sitting, I bought something a day before the year ends and I've got all of that sitting when the year ends, should I be recording that as a purchase?
No, I would. So with inventory, the way it is supposed to be reported, again, once the sale happens, that's when it gets moved from inventory over to your actual expense, or cost of goods sold is what it is. So if you're buying a large chunk of inventory at the end of the year and it has not been sold, but you have it on hand, it should be reported as inventory. It cannot be considered as a period expense until otherwise that good has been sold. Oftentimes there's different methods that are used for costing purposes. Like a FIFO is one of them, first in, first out, depending on the product that you're using, whether it's the same product, pricing can change throughout the year. There's an average cost base that you're able to use to determine what the inventory value amount is going to be. But again, like often in businesses, like we see that at the end of the year when you ask them, they say, okay, well, I don't know how much inventory do I have, right? If you look at the bigger companies, they do an inventory check at the end of the year to figure out the valuation of what they have on hand versus what they have purchased during the year, and they do a calculation according to that and see what their cost of goods sold was for the year. Yeah. Even for e-commerce, it's similar. Unless otherwise you're doing drop shipment, which then you don't really have inventory, where the cost is going to be only incurred when the purchase is made. But most of these, e-commerce, you do have to have inventory on hand. So that inventory valuation is a very crucial process. And I think it also allows you to understand your numbers quite better, I would say, is because, you have such a big purchase at the end of the year and you're using it as an expense. You might even say, well, I didn't even make any money this year.
But actually you did, yeah.
Right? And unfortunately, you actually did make the money, but it's just reported incorrectly. So for you, it might seem like, okay, I didn't make any money, and is this even beneficial for me or not? Yeah. But no, that purchase, the COGS is inflated. So then your actual profit margins are going to come out much lower. So it's not really an accurate picture of your business. So taking the reporting to CRA aside, even as an owner, having the right information and the right numbers being represented is crucial for you to understand where your business actually stands and how are you going to take it to the next level.
Exactly. And it's pretty simple, right? Because like at the end of the year, let's say it's 31st December, you just go to your warehouse, right? And just count the boxes or whatever inventory you have, right? And then like you mentioned about, you could do the average. So I bought this inventory, the start of the year, the price was $50 per box. Now it's $60. Average is $55. I either do that or I do FIFO, which is first in, first out. So because I bought this at the start of the year for $50, I'll assume that I sold it for $50. And now the inventory I'm sitting is the one I just bought last month or 2 months ago, and that's more expensive. I'm going to record all my inventory at this last month's purchase price, right? It's pretty simple. I think it's something that we should be proactive in doing, right?
Yeah, I mean, the biggest thing I would say is like it's the time consumption and the resources, right? For small to medium-sized businesses, that is usually what kind of holds them back in regards to this, is that they don't have the resources or the time to go ahead and do this inventory. But one of the things that is really helpful is having a software in place that is able to do the tracking for you, that essentially will bring you close to that number. Large warehouses, it's very difficult. They need to have the resources to be able to do that inventory count. But for smaller businesses, if you don't have large amounts of things that you're moving, even something like QuickBooks Online is able to track your inventory for you, right? So you get a rough idea on how much your cost of goods sold was actually and how much inventory you have left, and make a little bit of an adjustment at the end of the year if there was any bad returns or things like that you can do. But yeah, these are some of the most common mistakes that we see in today's day and age when it comes to e-commerce.
And that's why you need great accountants. So in summary, for some of the mistakes that e-commerce store owners are making, and we see them on a daily basis, is number one, you want to be completely segregating your personal and your business expenses. Number two, you want to be tracking all expenses that you're making on the personal side, your home, your car, any other expenses, subscriptions, and you want to be making sure that you have a spreadsheet or some sort of template, right? Number three is making sure that you're registering for HST on time or provincial sales tax. Number four, you're making sure that the payouts, you're not recording the payouts as your gross sales. You're taking the actual sales that you made and then making sure that the marketplace fees are shown as expenses and the payouts are the net of that. And the last one, making sure that your inventory is valued and it's there on the books so that your books are not showing wild swings. If you found this video helpful, definitely hit like. If you hit subscribe and press the bell icon, you're going to see more of these videos pop up. They're just going to help you save tax, help you keep your books clean, and avoid CRA audits. Thank you for watching. See you in the next one.